The gap is already printed on your TradingView charts when the bell hits. A clean pocket of white space between pre-market and the first opening candlestick. Your cursor hovers over the entry button as level 2 flashes like a strobe. Bids stacking, offers refreshing, order flow spiking. You can feel your stop loss finger, ready to anchor just below the pre-market low or just above it if you're fading the green gap. The first 5 seconds look like certainty. A surge, a yank, a wick that promises a runaway move. Your brain does the math faster than your platform. If you take 500 shares and it pops 50 cents, that's your morning. Don't miss it, whispers the little voice that only shows up when the bell rings. You click. Spread widens. A hidden iceberg prints against you. The opening auction finishes filling, the tape inverts and you're red before your stop loss even registers. You tighten the stop to give it a little room, then move it just this once, and the wick becomes a candle. The candle becomes a flush, and the flush becomes a lesson you thought you'd already paid for. Here's the part most traders don't see while they chase that first entry. The market is not a judge of your pre-market bias. It's an auction testing where your position can be forced to puke. Mark Douglas called it the mental edge beliefs colliding with randomness, and the open is where those beliefs are most brittle. Trading in the zone hammers a probability mindset, but at the open we tell ourselves a story instead. Gaps must fill, or gaps must run. The brain loves a story more than it loves statistics. Brett Steenbarger would call it performance pressure. As the bell hits, your self-talk flips from process to P and L, and your attention narrows until you're trading your fear, not the tape. Meanwhile, Trading Psychology 2.0 reminds us social proof hijacks us. Overnight threads and chat rooms act like mirror neurons, so you copy the room's conviction and label it plan. In The Way to Trade, systematic discipline means rules first, feeling second. But at the open, rules dissolve in adrenaline. Volatility spikes, spreads breathe, liquidity hides, and your brain mistakes speed for clarity. Market Wizards is littered with stories of pros who stop trading the first minute, because that minute is designed to find the offside crowd. If you've ever seen order flows shove price one way, tap stops, and rip the other direction, you've witnessed the auction's true job. Price discovery through pain. This is where trading paradoxes live. Perfect-looking gap setups often fail first. The best trades feel uncomfortable. More analysis of pre-market lines can actually dull your execution. Tighter stops at the open can equal bigger losses once the tape wicks both sides. Add neuroscience. The green flash on P and L sends a dopamine jolt that pushes you to press entries early. A sudden red tick spikes cortisol, shrinking your time horizon. The first opening burst pumps adrenaline until your hands move before your rules can. That's why most traders lose money, and why your first entry after the open is usually wrong. Not financial advice. Past patterns don't guarantee the future. And risk management is survival, but your brain won't remember that while the first candle forms. Here's the costly pattern, step by step, as it drains accounts in equities, forex and crypto. The bell rings and you're anchored to an overnight gap narrative. It must fill, or it must trend. You click a marketable entry right into the imbalance. Liquidity thins, slippage bites, and the wick takes you negative fast. Cortisol surges and you do one of three things. Move your stop loss to avoid the pain, double down to average for a better exit, or bail flat then re-enter in the same direction on the next micro pullback. That sequence stop loss removal, averaging down, and FOMO re-entry is the revenge trading loop in disguise. If you are fading a green gap, you'll see the first push higher. Interpret it as exhaustion. And short right into the continuation, because your chart pattern recognition has crossed into hallucination. You're seeing a top that hasn't formed. If you were chasing a gap and go, you'll buy the first break of pre-market high, set a tight stop, get wicked out, then buy back higher when it re-breaks now with worse risk reward. Do this across multiple time frames, 1 minute, 5 minute, 15 minute, and the opening auction will whip you from confident to confused in minutes. The worst part, you'll finish the session thinking your analysis was right and your timing was off. That belief magnetizes you to the exact same trap tomorrow. Meet Marcus, the risk manager. He doesn't wear that label because he's timid. He wears it because he's learned with scars that risk defines the trade. He runs 3 monitors: trading view charts with pre-market volume profile, an anchored VWAP from the pre-market session, a level 2 window with time and sales for his main symbol, and a journal panel that forces him to select an entry archetype before he touches his keyboard. His opening routine looks mechanical because the way to trade taught him systems beat moods. 15 minutes before the bell, he tags the gap as earnings-driven, news-driven, or broad market beta. If it's news-driven with thin float, he marks the liquidity pockets above and below pre-market extremes and sets an alert at each. He defines one and only one first trade type allowed, ORB after 3-minute range, with confirmation through order flow, or VWAP, reclaim after the first liquidity sweep, never both. He sizes in R multiples 0.25R at the open, capped at 0.5R for any first trade, because Douglas drilled the probability mindset into him. A small R, lost at the open, keeps him solvent for the high-quality setups later. He speaks to himself the way Steenbarger recommends, process goals, not P&L. His process goal is embarrassingly simple. No market orders in the first 60 seconds, no stop-loss removal under any circumstances, and no averaging until the initial stop is hit and a fresh setup emerges. Marcus tracks his cortisol tells, shallow breaths and over-scrolling level 2. When he notices them, he steps back, watches the opening auction complete, and lets mirror neurons fire in the chat without him. He has a rule he stole from a Market Wizards interview. When the tape looks effortless, you're late. When it looks scary for your bias, you might be early. So he waits for the paradox. He longs the gap up only after it scares longs, by undercutting the first minute low and reclaiming VWAP with buyers hitting the offer on the tape. If he's shorting the gap fill narrative, he wants the reclaim to fail at pre-market high with heavy absorption and a lower high on 1-minute RSI divergence that actually aligns with order flow, not a hallucinated pattern. He carries no illusion that the first trade must work. He assumes the opening candle is a trap and structures his position sizing so that the trap costs him less than lunch. Marcus's rewiring didn't come from grit alone. It came from building a circuit that fires the right behavior before dopamine and adrenaline take the wheel. He begins with a pre-market bias audit from Trading Psychology 2.0. He writes his gap narrative on paper, then writes the opposite narrative next to it, forcing his brain to consider both price discovery paths. He uses a 2-gate rule before the first entry. Gate 1 is structure. The setup must align across timeframes with a clear risk level that is not inside the spread. Gate 2 is behavior order flow must confirm acceptance or rejection at that level. If one gate fails, he logs no trade. From the disciplined trader, he adopted forced awareness. He reviews 3 screenshots of past opening losses, circles where he moved the stop, and deliberately feels the pain again for 20 seconds. Then he breathes 4 seconds in, 6 out to lower arousal so he can act from plan instead of ego. He automates what he can. Hotkeys place a bracket, entry, stop loss at the invalidation wick, and a first scale at 1R. He disables the ability to widen his stop with a hotkey entirely. He journals in the style Steenbarger suggests, self-talk, market talk, and outcome. Self-talk is graded. Was it about P&L or process? Market talk is graded. Did he describe auction behavior or just his fear? Outcome is just R, not dollars. He sets alerts for pre-market high/low, VWAP, reclaim/fail, and the first 3-minute O, R, B. While alerts run, he does nothing because the way to trade framework says the system triggers him, not the other way around. He accepts the paradox that more analysis often means worse execution at the open. Instead of adding screens, he removed one. He added a cooling off protocol. If the first trade is a loser, he starts a 3-minute timer where trading's disabled. That blunts the revenge trading loop and breaks the cortisol chain that shrinks stops and expands entries. And because most traders lose money, he treats survival as a skill. If his first 2 attempts lose a combined 0.75R, he shuts down opening tactics for the day and shifts to mid-morning structures where spreads and volatility compress. He repeats the disclaimers aloud. Not financial advice. Past patterns don't guarantee future results. Risk management is survival. It sounds theatrical. It isn't. It's how he keeps his beliefs from hijacking his entries. So what changes when Marcus does all this? The first entry after the open stops feeling like a verdict and starts feeling like a probe. He accepts that the auction's first job is to run stops and test liquidity, not reward his pre-market story. He watches volume profile to see which side gets acceptance, not just which candlestick colour is printing. He sees how mirror neurons, fed by social media streams, urge him to copy conviction. He notices the urge and lets it pass. His dopamine spikes still come, but he now earns them by executing rules, not by flashing green P&L. He leans into the trading paradox. The best opening trades often feel worse to click the long, on a reclaim after a scary undercut, the short on a lower high after a squeeze. He knows tighter stops placed inside opening noise create bigger losses through repeated scratches. He sets stops beyond the true invalidation and sizes down so the R remains sane. He knows more screens add more noise, so he keeps one main tape and one chart, trusting that less is more in the first 5 minutes. When he does take that first trade, he keeps position size small and the plan big. Initial scale at 1R to pay for information, trail behind structure, and accept the scratch if the opening auction flips. He no longer defines himself by the first entry's result. He defines himself by whether he honoured his gates, his stop, and his cooldown. Picture the transformation. The bell rings. A stock gaps up on earnings and instantly spikes 2%. Marcus doesn't chase. He watches the opening wick stab above pre-market high and then slam back through, trapping eager longs. He still doesn't short, he waits for the reclaim test. Buyers step back in at VWAP, tape prints sustained hitting of the offer, and the 3-minute ORB resolves upward on expanding volume that accepts value above pre-market high. He enters with 0.5 R risk, bracketed. Stop loss sits beneath the reclaim wick. First scale hits at 1 R, removing urgency. If the move rejects, he takes the 0.25 R net and starts the 3-minute cooldown. If it continues, he trails behind higher lows, ignoring the urge to tighten too soon. His self-talk is boring and precise. Entry validated, risk defined. Let the market pay me or pay someone else. Mid-morning he reviews his execution. Did he move a stop? Number. Did he break the cooldown? Number. Did he trade the story or the auction? The auction. At the close, he journals in R, not dollars, and tags the day. Rules followed, edge expressed. He ends with a simple truth that market wizards traders live by. You won't be paid for being right about gaps. You're paid for managing positions when the market proves or disproves your setup. And the first entry after the open. It's no longer a cliff you jump from. It's a measured step over a line you drew yourself, knowing you can step back anytime without shame. If you've been losing that first trade, you're not cursed, you're wired. The opening auction weaponizes dopamine, cortisol, and adrenaline against your plan. Mirror neurons amplify the crowd. Paradoxes disguise the best trades as the most uncomfortable ones. Your fix isn't more conviction, it's more structure. Define one allowed opening setup. Cap first trade risk at 0.5 R. Use alerts to let the system ping you. Refuse stop loss removal. Impose a 3-minute cooldown after any opening loss. Journal your self-talk, not just your P&L. Accept that most traders lose money and that past patterns don't guarantee future outcomes. Survival is a skill. Risk management is survival. When you rewire like Marcus, the first entry after the open stops being usually wrong. It becomes a small intentional test that either tags your stop or taps a trend, while your discipline finally does the heavy lifting.